We are moving on to the next volume. So again, back to volume number 1. This is chapter number 3, Goodwill, Nature and Valuation. So from this chapter, what you get is 4 marks question where they will be asking you to compute goodwill. So we have to learn 3 methods of valuation of goodwill. Other than that, for your 8 marks, that is in chapters admission and retirement, we had valuation of goodwill there. You remember we did goodwill valuation under average profit method. That formula already you have learned, average profit into number of years purchase. So actually that formula is from this chapter. So we have worked out problems before, that means comprehensive questions. So again in comprehensive questions they will be including this. Other methods also we will be studying. Sometimes those methods also they might ask other than average profit. Okay. So first we will discuss what is goodwill. You would be knowing the nature of goodwill, isn't it? What is goodwill? Goodwill is an intangible asset, or normally we will refer goodwill as good reputation or good name for the company or the firm. The meaning of goodwill is it is an intangible asset. 1 point. It helps the enterprise to be in an advantageous position and to earn extra profits without putting extra efforts. Understood? If you have a good reputation, okay, that means you are in an advantageous position. You can sell more, you can earn more, that means your profits will increase. For that, are we putting any extra efforts? At first, in the beginning, you will have to. That is how you are earning the goodwill or the good name. But after a period of time, when you earn that particular goodwill, you don't have to put more efforts to earn more profits. So that is the meaning of goodwill, and how you can earn these much profits or how you can earn this goodwill. That can be due to the efficiency of your management. Or when you supply good quality goods to your customers, they will be coming back to you. That means you will be having a good reputation among the customers. Or it can be due to the favorable location of your enterprise. So all these will affect the goodwill. Okay, so the meaning of goodwill you must know. Then they have given like characteristics, need, factors and all. Usually it is not asked, but again for 1 mark you read enough, that's enough. Then classification of goodwill, that classification also we have discussed before, purchased goodwill and self-generated goodwill. And we know that only purchased goodwill will be recorded in the books. What is purchased goodwill? Suppose we are purchasing a business, we are purchasing another business. So in return we will have to pay something, that's called purchase consideration. This can be paid either in the form of cash or in kind, that means in the form of assets. And usually how to determine this purchase consideration? Purchase consideration means the amount payable when you purchase an asset or when you purchase business. Here we are purchasing business, and it is calculated by using net assets formula. Net assets means the difference between assets and liabilities, or it can be the capital also. Okay, A minus L. But when you pay, suppose A minus L you got 50,000, but you paid 80,000 as purchase consideration. You paid more than that. This difference of 30 will be the goodwill. You understood? This is how we are computing goodwill actually. When you pay purchase consideration in excess of net assets, that excess amount is to be taken as goodwill. So excess amount you have paid, 30,000 you have paid more, that 30,000 is your purchased goodwill, which will be recorded on the asset side of the balance sheet. Only purchased goodwill will be shown in the balance sheet. Okay. The second classification of goodwill is self-generated goodwill. That means the name itself says internally generated or self-generated. How? Due to the efficiency of your management. That means due to the efforts of your workers, employees. Then other reasons which we discussed before, like when you sell good quality goods to customers, you will be having a goodwill that is self-generated. It's not like purchased goodwill. Then if you have a favorable location, customers will come to you. So all these are the reasons for self-generated goodwill, but it will not be recorded in the books. Only purchased goodwill will be recorded in the books. Okay, then the next topic is methods of valuation of goodwill. We have three methods. First method you write average profit method. For that formula we have discussed before, but again under average profit method you write subhead A, simple average profit method. Simple average profit method. And you give the formula for that. Simple average profit method is what you learned already, that is goodwill is equal to average profit into number of years purchased. Take down the formula, number of years purchased. Now average profit you know. What is average of something? You have learned in maths, no, average is total profit divided by number of years. This is number of years, whereas when we multiply for calculation of goodwill, what you have to take is number of years purchased. Both are different. Number of years purchased means for how many more years you can earn the same level of profit without putting much efforts, without putting more efforts or extra efforts. Okay, how many more years you will be able to earn that much profits. Okay, that's the meaning of number of years purchased. Number of years means when you compute average profit of 5 years, you have to take the number of years as 5. Number of years purchase is different. So this is simple average profit method. Okay, we'll work out illustration 4, and before that just take page 3.6. Did you see the heading like valuation of goodwill? So here we have written average profit, which is total profit by number of years. Total profit means you just have to add the profits given in the question. But here when you add the profits, what you have to remember is this is total normal profit which you have to take. Abnormal losses, abnormal gains would be included in this profit. Suppose you have a gain on sale of land. Okay, gain on sale of land or any fixed asset. Is this your operating activity that we have discussed in the chapter cash flow? Is this your main activity? No. Purchasing and selling, yes, it is your main activity. But other than that, when you get an additional amount on the sale or when you incur a loss on sale, all these are abnormal items. And when you have a gain on sale, what will happen to your total profit? Normally profit will increase, but it is an abnormal gain. So when you compute this total profit, actually what you have to compute is total normal profit. Abnormal items you will have to exclude. So if there is an increase in profit due to abnormal items, understood? If you sell goods, yes, of course you will get money, but that is not abnormal. That is your main activity. Understood? From non-operating activities and all, when you earn an additional income and if it increases your profit, that should be deducted. Just like we did in that cash flow statement. We added back all non-operating incomes, we deducted all non-operating expenses there. Same thing we'll have to do here also. So any abnormal incomes, if it increases your profit, what should we do? Less it. That means bring it down to get the normal profit. Any abnormal expenses, if it reduces your profit, add it to get the normal profit. Understood? So that is what they have discussed on page 3.6. Profit or loss, what is given we'll take. With that, abnormal losses we'll add because it is reducing profit. If it reduces profit abnormally, add it back. Bring it to the normal. Loss on sale of fixed assets, reducing your profit, add it back. Then overvaluation of opening stock. You remember last year's trading P&L format. Opening stock, we used to write it on the debit side, to opening stock. Overvaluation means it is increase in opening stock. Gross profit will be written here as to gross profit after you write by sales and all. Here we will be having on the credit side by sales, by closing stock and all. When the credit side is more, we know that it is a profit. That is why to gross profit is written. So what will happen if your opening stock increases? Debit side increases means loss increases. Automatically profit will be going down. If profit goes down, add it back. Understood? If it is the reverse, what will you do? Less it. Or undervaluation of closing stock. What will happen when your credit side is going down? Credit side moving down means the profit is going down. Understood? Profit going down, again we will add. So overvaluation of opening stock or undervaluation of closing stock, both are having the same effect. Then non-recurring expenses. Non-recurring means it will not happen again and again. Okay, like one-time payment and all. Non-recurring expenses we will have to add back because it won't be the main activity of the business, or it won't be a normal activity of the business. So we will add back all non-recurring items. Then capital expenditure charged as revenue expenditure. Again, capital expenditure means non-recurring expenditure, like purchased machinery is a capital expenditure. We will not purchase a machinery frequently, isn't it? Within 1 year we will not purchase an additional machinery again. So that is called capital expenditure, which you have learnt already in that NPO. So capital expenditure charged as revenue expenditure. See, they have given one example there. Purchasing machinery, what is the journal entry? Machinery debtor to cash. But if you write purchases debtor to cash, you know the answer is wrong. You are considering, when you write purchases debtor to cash, answer is wrong, and this is now considered as a revenue expenditure. But actually purchasing fixed assets to be considered as capital. It is non-recurring expenditure. Understood? So when capital expenditures considered as recurring item or revenue expenditure, what should we do? We should add it back because it would have reduced your profit. Understood? It is a mistake with your principle, that is called error of principle, that we studied last year. Okay, no need to go into detail, just understand this. If something increases your profit abnormally, you must deduct. If it is the reverse, you must add. Then less all the opposite items, abnormal gains, overvaluation of closing stock, undervaluation of opening stock, non-recurring incomes, then incomes from non-trade investments. So remember this, abnormal losses you have to add back, abnormal incomes you have to less. Now we will work out that illustration number 4. So it is given like Simran purchased Anita's business. So Simran will be your firm and you purchased Anita's business, agreed to value goodwill at 3 years purchase. Did you see that? Average normal profits of last 4 years. So in your formula, number of years purchase will be 3, and when you compute the average profit, the number of years is 4. Then profit for 4 years given there. Further facts are also given, that also we have to consider. During the year, asset was sold at a gain. So gain on sale, additional income or abnormal income, less it. Understood? So from the profits given, we can't simply add the profits and take. We have to first compute what is the normal profit. Then we will add all these and compute the average. So we will work out this one. Illustration number 4. We will do in a columnar format, a table format, just like they have done in the textbook. So we have to get the normal profit. Suppose these adjustments means following facts are given. No. If that sentence was not given, you can just add all those profits given. That will be your total profits. Since we have some abnormal losses and all, we have to compute the normal profits. So just write the question itself first, that is year ended and the profits given. Then the next two columns you have to add. This is your answer. One is adjustments, that is mentioned in the question. Then finally, when you do these adjustments with that profits, you will be getting the normal profits. So write the question now. Year ended 31st March 2017, 2018, 2019 and 2020. Then the amounts 90,000, 1,60,000, 1,80,000 and 2,20,000. Okay. Now we will go through the adjustments. Here also you have to see very carefully. First they are mentioning about 2017 and there is an abnormal gain. So that increased your profit. So less it. So less that 10,000. Then 2018 a machine got destroyed. 30,000 was written off as a loss. So it reducing your profit, add it back. Okay. So positive 30. Then 2019, yes, the next year the firm's assets were not insured due to oversight. That means by mistake or due to carelessness, insurance premium being rupees 10,000, it's a regular expense incurred every year. Okay. If it was a non-recurring expense, what would you do? Non-recurring expense, if you see that format, you have added back the non-recurring expenses, isn't it? Because it is unusual item. It's not happening again and again. It is unusual item, and unusual losses we have to add back. Unusual or abnormal losses. That's why non-recurring items being added back. But here they are saying like insurance premium, it's a regular expense incurred every year. Is it an unusual item? No, we know that for a company, for a firm, insurance premium is a regular expense or recurring expense. It is a usual item or a normal item. So what you should do? Only abnormal expenses will be added back. I have told you before, the specific word is abnormal items. This is a usual item or this is a normal item happening in the firm. So being a regular expense, what we are supposed to do? Less it, because we are supposed to pay expenses, isn't it? Every expenses you can't add back. Only abnormal or non-recurring you will have to add back. Since this is a regular expense, as usual you have to do, you have to deduct it. So now we compute the normal profit. Okay, fourth adjustment, nothing is there for fourth adjustment. So fourth year nothing is happening. So you just deduct and take these amounts. 1,60,000 plus 30 you have to do 1,90,000, then 1,70,000, and here there is no change. So entire 2,20,000 you can write. Just add this normal profits because total profit we have to compute. It is 6,60,000. To get the average you will have to compute the total. So there itself you add and compute. Okay, now we will write the formula for goodwill. It is average profit, always write formula, average profit into number of years purchase. Average profit means this is not average profit, that is total. Average will be 6,60,000 divided by, you can write the formula for average profit also, that is total profit by number of years. So 6,60,000 divided by how many years it's given? It is 4 years, isn't it? Yes. So 6,60,000 by 4, so that is 1,65,000 your average profit. Don't stop calculation with this, you have to get goodwill value. See, once you compute the normal profits, it's very easy. You just have to substitute figures. 1,65,000 into, don't write 4, number of years purchase here is 3 years. So 1,65,000 into 3 you have to do, that is goodwill value will be rupees 4,95,000. Understood? So this is how you have to value the goodwill. Then illustration number 6. Illustration 6, you can work out yourself. You must do that. Illustration 6 I am not showing, but you must do it in your notebook. Try it yourself. Doubts you can ask during Google Meet. Okay, weighted average profit, we will do one question from that. So, second method you write, that is subhead B, simple average profit method is over. You just have to apply this formula. Then for B, it is weighted average profit method, and the formula for goodwill you write now. Weighted average profit method, the second subhead, goodwill is equal to, instead of writing simply average profit, now you must include this term weighted average profit. So, this is weighted average profit into number of years purchase. Okay, weighted average profit into number of years purchase. How will you get weighted average profits? So, the new term here is weight, that is, previously we wrote total profit, now you should write total weighted profits divided by total weights. Total weighted profits divided by, not total number, here you have to take the total of weights. So, what is the difference? Just add that term weighted everywhere, that is all. So, that is how the formula is. We will work out illustration number 9. Okay, illustration 9 we will do now. So, here for every year they will be assigning weights, like you see that question. Did you see that illustration 9? Year ended, years are given, profits are given, then weights are given as sentence, not in that table. First paragraph, last sentence you read, weights assigned to each year. 2015 the weight is 1, then the weight is 2, then the weight is 3. Likewise, they have given the weights. Then it is to be computed at 3 years purchase, that also mentioned. Then below that some adjustments are given. You have to get the value of goodwill. Since we have certain adjustments, that means compute the normal profit like in previous question. So, we will draw the format again. It is year ended, then the profits given, then we have to do certain adjustments. So, we will get the normal profits. And year ended here is 15, 16, 17, 18, 19. The first two columns you copy from your question. 90,000, 80,000, 1,25,000, 1,50,000 and 1,75,000. Okay, these are the two additional columns you need in your answer. Adjustment first you will read. Abnormal loss of 15,000 and it is for 2015. Here also you have to consider. So, it is an abnormal loss. What should we do? If it is a normal loss, what should we do? Less it. But abnormal loss means it is reducing your profit, add it back. So, here we will add back that 15,000. Then the next one, abnormal gain, means you have to less and it is for 2017. So, not for this year. Okay. So, second year nothing is happening, be very careful, do not write that figure here, it is for 2017, less it, abnormal gain. Then closing stock overvalued, that we discussed, no, when your closing stock, that means something appearing on the credit side, it is increasing. What is happening to your credit side? Increasing. When credit side increases, profit also increases. What should we do? It is an abnormal gain which we have to less. When profit increases, bring it back to normal. So, less this item, amount is 15,000, that is for the year 2018. Okay. Now it's not over, so we deduct it in 2018. Now we know that the closing stock of 2018 will be the opening stock of 2019, and 2019 profit also we have. So we have to consider this. 2018's closing stock will become the opening stock of 2019. What will happen to opening stock? As usual, like this itself, opening stock will increase. Closing stock here they have increased. So the next year opening stock will be increasing by the same amount. But opening stock, we know that it's something coming on the debit side. When opening stock increases, debit side increases means it's a loss actually, that means profit is going down. Okay. When profit goes down, this particular item now to be added. So in the next year, the same figure will be added because there it is overvaluation of opening stock. Okay. So now we will compute the normal profit. You just add and take. The normal profits 1,05,000, then 80,000, then 1,15,000, 1,35,000 and 1,90,000. So this is your normal profits. Don't add it now because normal profits now to be multiplied by weights. Then only you will be getting weighted profits. Understood? So we need to compute the weighted profits now. For that, just like they have done in the question, we will draw a format. Since here we have weights, no need to find total now, we have to multiply. If you want, you can add one more column. If you have space here, you can add weights column here, then you will get weighted profit. That also fine. Or else we will just draw it as a separate column. It's not compulsory, you can add column there itself. Like normal profit, we have to multiply by weights, then only we will get weighted profit. So the normal profits, just copy from the table, it is 1,05,000, it is 80,000, 1,15,000, 1,35,000 and 1,90,000. Years, even if you don't repeat, it's okay. Then weights, you write 1, 2, 3, 4. 1, 2, 3, 4, 5. It's given no. The last sentence of paragraph 1. Did you see the weights given there? So this is how the weights are. Now you have to multiply this and take the weighted profit. It's like 80,000 into 2. Is multiplied by the weights. 1,15,000 into 3, so it's 3,45,000. Then 5,40,000 and 9,50,000. Okay, now we will write the formula. Here we will have to add the total, so leave some space. Write the formula. Goodwill is equal to weighted average profit into number of years purchase. And weighted average profit means, just repeat the formula. Weighted average profit will be equal to total weighted profit by total weights. So here total weighted profit means you should add this column. This weighted profits column you have to add now. So the total is 21 lakhs, that's the total weighted profits. Similarly, you add this total of weights also, which is 50. Now apply these figures here. It is 21 lakhs divided by 15. So it's 1,40,000. It's not over. Don't make careless mistake. Calculation of goodwill is not over. Goodwill will be equal to 1,40,000 into number of years purchase, which is given as 3 in this question. So 1,40,000 into 3, 4,20,000, that is the value of goodwill. Okay, so with this, first method of valuation of goodwill is over. That is average profit method, which is divided into simple average and weighted average profit method.